So let's calculate the intrinsic value of Delta Airlines. And in order to calculate the intrinsic value of a stock, we need to estimate the future free cash flow of that company, discount it back to today's dollars, and divide that number by the number of shares outstanding. Now let's see the market cap of Delta. 14.5 billion. And the stock price is $22.69. That means they have 639 million shares outstanding. Now let's look into their financials. And the way any equity analyst or Warren Buffett does it, they calculate the free cash flow. That's how you figure out the value of a company. And then you calculate that way into the future and then discount those back to today's dollars. So we're going to pull their free cash flow, because cash flow can't really be manipulated. It's the actual cash that's left over after operating the business each year. So this is a good sign Delta has a positive free cash flow. Now let's look at their net income, and it's also positive. Also another good sign. So it looks healthy so far. The total revenue, it's been increasing pretty nicely. So as you can see, the free cash flow is a little more lumpy. It's 3.8 million, drops, goes up, then goes way up to 3.5 million, where something like revenue is a lot smoother, and net income not as smooth, but definitely smoother, because free cash flow is actually cash that goes in and out of the company. So if one year they spent maybe a couple of $1 billion on some new aircraft, all that cash is taken out in free cash flow, where on an income statement, it's not all taken out. It's depreciated over 20 or 30 years. So maybe only 5% of that cash amount is reported on the income statement. The rest of it is carried on the balance sheet. You have to be careful when you're looking at net income and earnings to make sure you really understand, because those numbers can easily be manipulated to however the company really wants it to. Of course, in the long run, everything should equal out, but the long run could be 20 or 30 years. So you need to look at the big picture. So let's find out their WACC. So their interest expense is 301 million. And let's see how much debt they have. So current debt, that's the debt due within 12 months, is 2.3 billion. And now the long-term debt due beyond 12 months is 8.9 billion. So 2.7% interest rate on the debt, which is pretty good. Now what's their income before tax? And their income tax is 1.4 billion. So they pay 23% in taxes. That sounds about right. So the 2.7% is reduced by the tax rate. You got a tax deduction. So they actually pay 2.07%. That's the cost of the debt. And now the cost of equity. So we need the beta. That's the volatility of the stock. It's a pretty good beta, 1.27. And the higher the beta, the more risky the stock is, and the higher compensation equity holders expect. So you can see 1.27, the cost of equity is 12%. But look, if I raise it to 2, it's much more volatile, so they expect a higher return. So 1.27%. So the cost of equity is 12%, the cost of debt is 2%, and if you combine those together, you get a WACC of 7.72%. And this is the cost that the company has to shell out in order to get money. So this is how they figure out investments in projects. If a project has a return of below 7.72%, they shouldn't take on that project. If it has a return of above 7.72%, they should, because that's how much it costs them to get money. So they should be earning a profit for their shareholders. And this company's a little more equity than debt. 57% of the capital structure is equity and 43% debt. So let's discount that 7.72%. So we have the estimated future free cash flow, and that's all created in my model with a terminal value at the end. We discount these numbers back to today's dollars, and then total is $58.5 billion. That's the value of the company. And if we divide that by the market cap, the shares outstanding of 639 million, the estimated stock price is 91.54, which is a lot higher than what it's trading at. So it was trading around $60. Now it's trading at a much better discount because it's trading at $22.69. But in the model, we have a 2.5% growth rate of the company. So if we lower that, because we're in coronavirus times, to 0%, because we're not sure if they're going to be even growing the next 2-3 years. So let's put a 0%, because I think that's more appropriate for an airline. And now it's down to 65.82, which sounds a little bit closer to where it should be, which if you look at their historical stock price the past 5 years, they were trading at about that price. So I think that's a good number. And you might be asking, why is the intrinsic value so much more than actual stock price? Because any equity analyst can come up with this. This is their job. If you ever read those reports that this Goldman equity analyst considers Delta Airlines a sell or a buy or a hold, they're doing these discounted cash flow models along with other things. And the reason the intrinsic value is so much more is because people don't have a good future expectation of the company. They're not seeing the value of the company improving. They actually see it struggling maybe, and the price of the stock is reflecting that. If they saw a company with a great future like Tesla, their actually intrinsic value is negative, but their stock is trading much higher than negative, as you know, because people expect the future of the company to continue to grow, even though they're investing so much money. So this is food for thought. This is my opinion on the company because this is my discounted cash flow model. Everybody has their own opinion. I'd like to hear yours. Please leave a comment. Let me know what you think, and thanks for watching the video.